Okay, let's unpack this. Welcome to our deep dive on KNOT Offshore Partners, ticker KOT.
Yeah, we're looking at their first quarter 2025 earnings call.
Exactly. We've got the earnings release, the management discussion, the whole package.
And the goal is to break down the key numbers, figure out what management's thinking.
And what it all means for KOT right now and, going forward.
Right. Where they stand.
So first up, the headline numbers for Q1. Revenues came in at $84 million.
Okay.
Operating income, $23.4 million. That flowed down to $7.6 million in net income.
And adjusted EBITDA. That's a big one people watch.
$52.2 million for the quarter. Pretty strong. And liquidity looked decent, too.
How much available?
$101 million at the end of March. That was like $67 million in cash and another $34 million they could draw down.
So good flexibility there. Those numbers, they really show consistency, right?
Yeah.
That's actually growth if you look further back.
Yeah, steady growth, especially revenue and EBITDA. It suggests things are running smoothly.
Well, operationally smooth. Important to remember, though, they depreciate vessels over, 23 years? Straight line.
Right.
So adding new ships, like through dropdowns, automatically pushes that depreciation expense up. It's just accounting, but it impacts net income.
Good point. Operationally, you mentioned smooth utilization was 99.5% for the ships they operate directly.
Wow, that's high.
Even with a couple of dry dockings starting, overall fleet utilization was still 96.9%.
That explains the solid financials. Ships working, earning money. That's the core business.
And they kept the cash distribution steady, 2.66 US cents per unit, paid out early May.
Makes sense given the performance.
Okay, so that's Q1. Now looking ahead, management sounded pretty optimistic about the market.
It's definitely bullish. They see significant growth coming in oil production that specifically needs shuttle tankers.
Yeah, not just general growth, but growth in fields where their ships are essential.
And the focus areas are key. Brazil obviously is huge. FPSOs starting up, maybe even faster than planned with more on the way.
And the North Sea, too.
Yeah, Java Casper and Penguins FPSOs finally ramping up production. These are concrete projects needing KOT's kind of hardware.
So more demand. What about the supply side? Are enough ships being built?
Well, that's the thing. They argued more new builds are actually needed. They foresee a potential shortage of shuttle tanker capacity. And they made a point that unlike maybe some other shipping sectors, these new builds tend to be backed by firm client charters already, less speculative building.
Which reduces the risk of ships hitting the water without work.
Exactly. And that market tightness. It makes their existing contracts, and especially the options on those contracts, much more valuable.
Right. They mentioned a backlog of $854 million at the end of Q1.
Yeah, firm contracts average 2.3 years, which is okay. But then you have options averaging another, 4.7 years on top of that.
That's substantial.
And in this kind of strengthening market, clients are much more likely to exercise those options, right? It locks in capacity they might struggle to find elsewhere later. The company clearly expects this.
So longer revenue visibility. And this all ties into their main growth strategy, dropdowns.
Absolutely. The timing is perfect for it.
Yeah.
Their sponsor has this inventory ready, 4 existing vessels, 6 being built.
All with long-term charters already secured, like 5 years minimum.
That's the key. Secure contracts.
Okay.
So when KOT buys these or drops them down, it's seen as immediately accretive, adds to cash flow per unit.
Plus, increases the backlog, lowers the average fleet age.
And generates predictable cash flow. Their whole strategy is built around this. Get visibility on charters, then do drop downs. They said the process usually takes, 2 to 4 months.
And they seem confident about finding work for any ships that do come open later.
Especially in Brazil, given how tight it is.
Yeah.
North Sea may be a bit slower, but improving conditions there too for recontracting.
Okay, makes sense. Let's switch gears a bit to the balance sheet. Debt.
Always important. Total debt was around $948 million, mostly secured, like $932 million.
And they pay down a fair bit automatically each year, right?
Yeah.
Installment payments.
Yeah, roughly $90 million a year just melts away through scheduled repayments.
Which is interesting because remember that vessel swap? They took on $73 million in debt with that.
Right.
But their total long-term debt only went up $47 million in the quarter. Shows how much those repayments offset things.
Good catch. So they're actively deleveraging even while doing some transactions, but their maturity is coming up.
Yeah, late 2025 looks busy. 2 unsecured revolvers in August and November.
And a bigger secured loan.
$139 million for the Toba and Sonova vessels, due September-October timeframe. Plus, looking out 12 months from Q1, another $96 million in current installments.
So refinancing is definitely on the agenda. Management seemed pretty calm about it, though.
Yeah, they highlighted their track record, said talks are underway, no red flags so far.
And the plan is basically like-for-like replacement. Medium to long-term loans, amortization, balloon payment at the end.
That's the typical structure they aim for. Now, related to debt cost interest rate swaps.
They have hedges, but they expire.
Yeah.
Average life left is only about 1.5 years.
So they'll need to roll those hedges.
And that's where current rates bite. New swaps, based on current SOFR, would likely be in the, say, 2.5% to 2.8% range, higher than the old ones expiring.
Meaning interest expense could tick up as those roll over unless rates drop significantly.
Right. Now, connected to these refinancings, an analyst brought up an interesting point.
About potentially borrowing more.
Exactly. If vessel values are up, maybe they can refinance for more than the maturing amount, generating extra cash.
Which could, in theory, be used to accelerate those drop-downs, right? That was the analyst's angle.
It was, and management acknowledged, yeah, that's possible. It could create liquidity for growth.
But, and this is where it gets interesting, is that the best use of capital?
This raises an important question. That's the core of the capital allocation debate. They pay the 2.6 cents distribution. But what about other cash flow or this potential extra liquidity? Drop-downs or buybacks?
The analyst made a strong case for buybacks, didn't they? Suggesting the implied IRR could be really high, like 25-30% maybe.
Yeah, comparing that to the WACC, the cost of capital for drop-downs, which is probably more like 7-8%, even though drop-downs add immediate cash flow.
So a big potential return gap on paper. How did the company respond?
Their stated focus remains on fleet growth, long-term value creation for the partnership. That's what drop-downs deliver.
But they didn't rule out buybacks.
No, they said the board looks at both, but they also flagged a practical issue. Their units don't trade very heavily.
Ah, low volume. So trying to buy back a meaningful amount could just push the price up sharply, making it less effective?
Potentially, yeah. It makes executing a large buyback program tricky. So it really highlights this tension. Growth focus versus potential high return buybacks versus practical execution.
A key thing to watch. Let's quickly cover some operational bits. That vessel swap in Q1 Dan Sabia for Lever Knudsen.
Right. Important note, it was a swap, not a cash purchase of a new drop-down. One ship exchanged for another.
And they took on $73 million in debt attached to the Lever Knudsen.
Yeah, they mentioned the vessels themselves were valued somewhere in the $30 million range combined.
So the debt assumed was way more than the vessel value exchanged. Negligible cash involved.
Exactly. Also, the Hildenson got a new 1-year charter with Shell starting late March.
In Brazilian.
Charter extended to September, then it gets handed back and goes over to Equinor.
Okay. And dry dockings, too, started Q1, but most of the time off-hire was actually Q2, mainly April.
Correct. And the Tova is scheduled for its dry dock later this year, probably straddling Q3 and Q4.
Got it. So pulling it all together, why should someone following KOT or even just the shuttle tanker space care about all these details?
Well, because it all connects, doesn't it?
Yeah.
You've got this really strong market outlook.
Driven by specific projects in Brazil and the North Sea.
Which creates demand, tightens the market, and makes their assets more valuable. That backdrop underpins their whole strategy.
The drop-down strategy focused on growth.
Which, in turn, depends heavily on financing. Can they successfully refinance that upcoming debt? Can they maybe pull out extra cash to fund those drop-downs faster?
And that leads straight back to the capital allocation question. Is growth the absolute best path? Or should some capital go back via buybacks despite the trading volume issue?
Exactly. Understanding these moving parts, the market dynamics, the financing constraints and opportunities, the strategic choices management is making between growth and returns, that's crucial. It's not just about the Q1 profit number. It's about the whole picture and how they're navigating it.
Okay, before we wrap up, the obligatory disclaimer, this is definitely not financial advice.
Nope. For informational purposes only. We're just discussing public information from KOT.
Always consult a qualified financial advisor before making any investment decisions. Seriously.
Okay, disclaimer done.
So given everything we've talked about, the strong market, the drop-down pipeline, but also the debt coming due and that whole buyback versus drop-down debate, here's a maybe slightly unconventional thought. Just thinking out loud.
Uh-oh, here we go.
No, just a hypothetical. You could think about a potential pairs trade, right?
Okay.
Go long KOT units, betting on that growth story, the drop-down execution, maybe leveraging refinancing liquidity, capturing that strong market.
And the other side of the pair.
Maybe shorting a peer, perhaps in a different, maybe more mature shipping segment, one that's maybe more focused on just returning capital via dividends, less dynamic growth, fewer specific catalysts like KOT has with the shuttle tanker demand.
So betting on KOT's specific growth potential leading to relative outperformance.
Kind of. The idea being their unique mix of market tailwinds and accretive growth might drive better relative returns than a company just steadily paying out dividends without that same upside potential.
Yeah.
It plays on that tension between growth investment and capital return we discussed.
Purely speculative, of course.
Absolutely. Just a thought experiment tying together the themes from the call, not a recommendation. So, recapping. We covered KRT's Q1 results, the very positive market outlook, the critical financing plans and upcoming hurdles, and that really interesting strategic debate on capital allocation.
Yeah, looking forward how they balance that growth ambition via dropdowns with managing the debt profile and considering shareholder returns.
Yeah.
That's the key story for the next year, I think.
How they strike that balance will really dictate their trajectory. Thanks for joining us for this deep dive into KNOT Offshore Partners.